Welcome. Here's a question worth sitting with. How do you actually know whether your business is performing well? Most owners have a gut feel, but a feeling isn't a fact. In this video, we'll look at business benchmarking, comparing your numbers against your industry to see objectively where you're strong, where you're not, and what to do about it. It's one of the most useful exercises a business owner can do, and it's far simpler than it sounds. I'm from the advisory team at Quantum House Australia, accountants and tax advisors. This is what we'll cover in this video. We'll start with why benchmarking matters and what it actually is. We'll look at where reliable benchmark data comes from and a point a lot of owners miss, the role the ATO's own benchmarks play. We'll go through the key metrics worth measuring and the surprising things benchmarking tends to reveal. Then a short real-world example. After that, how you turn the data into action, the common pitfalls to avoid, a simple way to get started, the key takeaways, and how we can help. Let's start with why this matters. Most business owners have a sense of whether things are going well, but without an objective reference point, it's genuinely impossible to know whether you're outperforming your market or quietly leaving significant value on the table. You might have a gross margin you're proud of that's actually below your industry's average, or a cost that feels perfectly normal but is well above what your peers are paying. Benchmarking closes that gap. By comparing your key financial metrics against industry averages, you can see exactly where your business is strong, where it's underperforming, and, most usefully, which actions will have the biggest impact on your profit and growth. It turns vague confidence into a clear, prioritized picture. So, what is business benchmarking precisely? At its simplest, it's the process of comparing your business's financial and operational performance against external standards, usually industry-wide averages or sector-specific key performance indicators. In a financial context, that means lining up metrics like your gross profit margin, your net profit margin, your labor cost as a percentage of revenue, your cost of goods sold, your debtor days, and your return on assets against the norms for businesses of similar size in your industry. And here's the mindset that matters. The goal isn't to judge your performance in absolute terms. A number is neither good nor bad on its own. It's to identify your relative strengths and weaknesses compared to a genuinely relevant peer group. For benchmarking to be worth anything, the data behind it has to be reliable. So where does it come from? Two sources do most of the heavy lifting in Australia. The first is IBISWorld, one of the most comprehensive sources of industry-specific financial benchmarks, with detailed data on margins, cost structures, and financial ratios across hundreds of Australian industry sectors. The second is the Australian Taxation Office, which publishes its own small business benchmarks across more than 100 industries, compiled from over 2 million business tax returns. The strongest analysis draws on both independent industry research alongside the ATO's own real-world figures, and then sets them against your actual financial statements. Now, that ATO data deserves a moment of its own because it cuts two ways. The ATO doesn't just publish its benchmarks for your benefit, it uses them. It compares businesses' financial ratios against the expected range for their industry, and where a business falls outside that range, it can trigger a closer look at their tax affairs, a compliance review. So benchmarking isn't only about finding growth opportunities, it's also a form of risk management. If you know where you sit against the ATO's range before they do, you're in a position to understand the difference, explain it if it's legitimate, or fix it if it isn't, calmly, on your own terms, rather than in response to a letter. That's a far better place to be. Which metrics are actually worth benchmarking? The most impactful ones vary by industry, but a core set comes up again and again. Gross profit margin, your revenue minus the cost of goods as a percentage of revenue. Net profit margin, what's actually left after all your costs. Wages and salaries as a percentage of revenue, and rent and occupancy costs the same way. Two of the biggest overheads for most businesses. Debtor days, how long, on average, it takes your customers to pay you. Inventory turnover, if you're a product business, how quickly stock converts to sales. Each of these tells a different story about where your business sits relative to its peers, and together they build a remarkably complete picture. Here's where it gets genuinely useful, because benchmarking surfaces issues that are simply invisible when you only look at your business in isolation. Let me give you the two most common discoveries. The first, a business whose gross profit margin is perfectly in line with industry norms, but whose net profit margin sits well below average. That pattern points straight at overheads, wages, rent, administration, being disproportionately high, even though nothing looked obviously wrong. The second, debtor days running well above the industry average, which quietly signals a systemic problem with collections that's eroding your cash flow month after month. On their own, these are easy to miss. Against a benchmark, they jump out. Benchmarking turns these invisible drags on performance into quantified, addressable problems, and that's the first step to fixing them. Let me make all of that concrete with a short hypothetical example. Picture Apex Electrical, a fictional small electrical contracting business. The owner was flat out with work and had come to treat constant cash flow stress as simply how the trade is. A benchmarking review reframed the whole picture. Apex's gross profit margin was healthy and right on par with its industry, so pricing and job costing were sound. But two numbers stood out. First, its net profit margin sat well below the industry average, which pointed to overheads, admin and vehicle costs, running hotter than its peers. And second, more strikingly, its debtor days were sitting at around 58, against an industry norm closer to 35. In plain terms, Apex was bankrolling its customers for more than 3 extra weeks, quietly tying up tens of thousands of dollars in cash. Once that was quantified, the fixes were obvious: tighter invoicing terms, deposits on larger jobs, and a disciplined follow-up routine. Within 2 quarters, debtor days were back near the benchmark and the cash flow pressure had eased, without winning a single extra job. Nothing about the business had felt broken. It took a comparison against peers to reveal exactly where the value was leaking. That's illustrative, of course, but it's exactly how this plays out. Now, data alone doesn't change anything. What you do with it does. That's why, at Quantum House Australia, benchmarking is built into our business performance review and forecast service. We take IBISWorld sector data and the ATO's figures, set them alongside your own financial statements, and produce a detailed comparative analysis. But we don't stop at presenting numbers. That's the part most people find useless. We translate the findings into a practical action plan with specific recommendations and a financial model that shows you the dollar impact of each improvement so you can prioritize the changes that matter most. The whole thing is designed to be acted on, not printed, admired once, and filed away in a drawer. There's one more thing that makes the difference between benchmarking that helps and benchmarking that gathers dust, and that's treating it as a habit rather than a one-off. A single snapshot tells you where you stood on one day. The real value comes from tracking your position over time. That's why we meet with you quarterly, to track progress against the plan, see what's working, and adjust the strategy as your business evolves. Markets move, your cost base changes, you take on new people or new premises, and your benchmarks should move with you. Over a year or two, you build a clear, comparable picture of your trajectory, not just an isolated moment in time. That's when benchmarking really starts to compound. A few pitfalls to steer around, because benchmarking done carelessly can mislead as easily as it can illuminate. The first is comparing yourself to the wrong peer group, the wrong industry, or the wrong size band, which produces answers that look precise but are simply wrong. The second is treating benchmarking as a one-off, when, as we just said, the value is in the trend. The third is chasing vanity metrics, the numbers that flatter you, rather than the ratios that actually drive your profit and your cash. And the fourth is ignoring the ATO range altogether, and being surprised when an outlier draws attention. Each of these is easy to avoid once you know to look for it. So how do you get started? Let me leave you with 3 simple questions. 1. Do you know your gross and net profit margin and how they compare to your industry's norms? 2. Do you know your debtor days? How long it really takes your customers to pay you? And 3. Do you know where your key ratios sit against the ATO's benchmark range? If you can't answer those 3 confidently, and most owners can't, at least not precisely, then a benchmarking review is exactly where to begin. The insights from even a basic exercise can be genuinely transformative, and you almost always learn something about your own business that you didn't know. Let's pull it all together. Benchmarking gives you an objective reference point. It replaces gut feel with evidence. The best analysis uses both IBISWorld and the ATO's benchmark data. Remember that the ATO range is both an opportunity and a risk, so it pays to know where you sit. Focus on the metrics that matter: margins, your major overheads, and debtor days. Benchmarking's real power is that it reveals invisible drags as fixable problems, and it works best as an ongoing habit, not a one-off report. Get those right, and you'll always know how your business is really tracking. This is where we come in. Quantum House Australia works with SMEs across a broad range of sectors to run meaningful data-driven benchmarking. We bring real comparative data, IBISWorld and ATO figures set against your own financials, not guesswork. We turn it into an action plan with specific recommendations and a model showing the dollar impact of each one. And we make it a quarterly partnership, tracking your progress and adjusting as your business changes. One more thing, because we're accountants first, your benchmarking sits within your wider tax and financial position. And if your numbers ever raise an ATO query or a dispute, we can draw on our colleagues at Australian tax experts, tax advisors and lawyers. So, accounting and legal expertise sit together in one place. So here's the invitation. Find out exactly how your business compares to your industry, instead of guessing. If you've never benchmarked your performance, the insights from even a first review can genuinely change how you run the business. Quantum House Australia runs data-driven business performance reviews for SMEs across a wide range of sectors. Visit quantumhouse.com.au or call our Sydney office on 1300 809 697 and we'll arrange a review to show you precisely where you stand. Thanks for watching. Quantum House Australia, accountants and tax advisors setting a new standard.